Good morning, everyone, and welcome to this weekly macro session. Welcome back, Tim. How are you doing?
Good morning, Fabio. I'm doing good. Good morning, ladies and gentlemen, from whatever where you listening.
And so take it away. We have some. Sorry for the background noise, guys. Hopefully we can hear it, but let's take it away.
Yes, I have a little birdie here somewhere above my window. I don't know. I'm just trying to talk all the time that you guys don't have to bother with background noises. Maybe close the window again. Wait a minute. All right. Okay. Let's get into it. Last week we didn't have a macro update, unfortunately. Would have been a pretty cool one because I did some deep diving into the oil market, and if you have watched recent events over the weekend, it would have been a great trade. But I decided today to do this like a little bit of reverse engineering. So hopefully you guys are getting a little bit more color on this market, how to look in it, and how to maybe set up trades as well. But as usual, we will always take a look into the last week, and we will always have a look on this week, what's important. So as usual, we are starting with last week in SPX. Don't get confused by the basic drawings here. It's just stuff out of my mind, what might happen based off the options positioning. But in general, last week was, pretty boring. Let's keep it like that. Monday, Tuesday, nothing really big happened into the market. It's really technical trading, right? Obviously, the 6,000 strike in SPX keeps us a little bit entertained, and we are trading around this all the time. It was a little bit obvious that higher highs, even on daily time frames or weekly time frames, they got reversed pretty quickly, some sort of exhaustion. I'm still in the camp. This is due to the positioning in SPX. Of course, you will have the same pattern then in the ES futures if you are trading ES futures, and the same goes for the QQQ or the NQ future, right? This stuff works basically the same, but keep it simple. I just post the SPX chart all the time. On Wednesday, the 11th last week, CPI numbers, highly awaited, came in lower. First reaction of this was some unwind of event hedges. We traded a little bit higher pre-market, got reversed then later into the session, and then Wednesday, Thursday, Friday, the first news from the escalation, Israel, Iran, it came into the news tickers, and people were a little bit scared, at least during the first day session, where Israel and Iran announced that the escalation might happen pretty quickly. SPX ES have dumped pretty violently. This dip got bought then. Basically the same stuff happened on Friday. What's always a little bit of a pattern with this geopolitical risk, into the closing from Friday, you see people taking some risk off positionings. Also, we had some volatility uptick in VIX and other products. We will go over this a little bit later in a few slides. And we ended up basically on lows during Friday for the week. And the last part then is the Globex Open from Sunday afternoon, Sunday night. Dip got bought. We'll talk about later a little bit over this. But what is in play generally in the market? The chart on the left upper side is a snapshot from some sectors from the last week. The clearly outperformer over there was the XLE, which is the energy ETF from the US. Of course, with rising oil prices, also those prices tend to get higher a little bit. Weekly gain like 5.53%, followed by semis, tech, and also TLT, which is the 20-year bond ETF. Overall, we can say stocks are still more in play than bonds. Overall, all the US sectors have mediocre performance like the last 2 weeks. and with the outliner, the XLE, because of the saber-rattling, warmongering in the Middle East. That's the reason this little snapshot on the left lower hand side from Bloomberg has found it into the presentation. Oil fields getting attacked, blah, blah, blah. Gas fields getting attacked. All this stuff causes a little bit of cautiousness in equity markets, especially when we're considering the position right now, where people are still betting on the upside, but technically we are a little bit limited over there because of the positioning. We spoke about this on the last pane already a little bit. What the market is also a little bit watching, but not as closely as the whole war stuff, is of course tariffs, tariff deals, China, what is going on over there, how do the talks are going. I'm still in the camp we will continuing to front run this, building up bullish positions in US equities. And as mentioned, the technically side caps us a little bit in the upside. But thank God, this Friday, options expiry, right? OPEX. So keep it a little bit simple because we don't want to dig too deep into this because I would like talk 2 hours over here. Market gets cleaned a little bit out in terms of positioning, right? Think about the gamma that's out in the market and is not actively trading over there. Also later this month, the big JPM hex caller in the SPX will find his way out of the market and will start up with a new one. But this is the last trading day of this month, so in like 2 weeks, still something people will watch. And for the futures trader, this week is rollover, right? If you're trading NQ, ES, RTY, YM, or the other proxies of these markets, be sure to put up the correct contract, right? I think if we have new people in here, happens all the time, you pull up the wrong contract and you're wondering why your contract is gapping up or gapping down massively. Could be maybe you're not aware of the rollover this week, so keep this in mind. Look at the most liquid and the most liquid contract, because this is usually the best one you should trade. Volatility from last week, we looking a little bit into VIX positioning. I also brought up a little bit volatility smile for the VIX, and we are basically touching out from the story from Friday over here, right? There is a VIX chart down there, and you can see this big gap up on Friday, and VIX trading into the 21 points. So big overnight gap. Yeah, because of the Iran-Israel thingy. Also positioning in VIX seems pretty, let's keep it reactive. That's the reason why I named this pane. We are not on summer vacation here in volatility, right? It looks like people are still having some sort of hedges to the upside. And if those positionings are going into the money, usually things are escalating pretty quickly. So if you are reading stuff over there into social media or whatever else that the market seems underhedged, or people are completely risk averse and have the opinion nothing bad happens, I don't share this view, to be honest. I still think people are aware of downside in equities. Whatever the reason is, we don't know. We just can look at positionings and compare stuff to each other. And that's the reason when the event occurs, like in the Middle East, you have stuff like other volatility indexes from the TDEX and SDEX. I brought up a chart on the left upper side, the orange line chart. It's the so-called TDEX. We traded pretty high on Thursday, Friday. The TDEX is an instrument you can watch where people are buying hedging products that are usually going behind 2 standard deviations, I think. Yeah, it's not just 1 standard deviation downside, it's over 2 and into 3 standard deviations. So big upside, right? That's the reason why it's called TDEX, tail DEX, tail risk in equity markets. And actually, it turns out, if we are looking at the future open from Globex this night, we don't need those hedges, right? Markets have been ticked up. There is no further escalation in the Middle East. Sure, bombs are flying, people dying, stuff is getting destroyed. But overall, the market seems pretty calm with this, right? So could be potential fuel for the upside, like always, when we have like, yeah, event risk hedging, or like in this case, tail risk hedging. If people are not wearing those insurance, they don't need it. Maybe they decide to go further risk on the equity curve. It's always potential for a little bit upside. But of course, you have always have to map this out with the position in the market. That's the reason why I hinted the OPEX this week. It's actually really important, because if we are going further this week, many of stuff that is actually in the money in SPX has its last trading day. So yeah, we should monitor this pretty accurately. The week ahead, it's not that much going on in terms of data for the US market. On Monday, so today, retail sales in 18 minutes, import-export prices. This is nothing really special where the market is looking at. From my side, the FOMC meeting, the press conference on Wednesday, June 18, is more important. Also, the next day is a holiday, right? So Friday, partly volume day, I would say. Maybe some people are deciding to turn the machines off or let the machines turn off. I don't know, just a hint from me. But anyway, what is important for June FOMC? As you can see with the red rectangle thing over there, we got a new dot plot on Wednesday, right? So this is basically a chart from the opinions of the FOMC members, how fast and how many rate cuts we are getting. So for the second year, which is this year, is next year, 26, interest rate projection out the curve, call it like that. And the main thing over here is they have to decide a little bit, is the market right with the decision just penciling in 2 cuts this year and 26 more cuts, right? That's the base case, which everyone is looking for. That's the reason we have this chart on the right side, the orange one. That's the so-called SOFR spread, right? SOFR futures getting traded for like, rate cut expectations. Keep it simple like that. And if we put out a chart, the December 25 versus the December 26 contract, it's trading pretty low, fairly low, right? So that's kind of the proof, chart-wise, what the market is thinking actually. Less cuts in 2025 because we are doing good, right? If you have attended previously Macro Mondays, you should be aware of our view that we are communicating with the rest of the world, that the April was mainly just unsecure volatility in markets due to the tariff stuff, but overall underlying we are still doing pretty decent, pretty strong in the US, right? So why cutting rates faster than we actually need in the US? Okay, so this SOFR spread shows you it's already a pretty crowded trade. On the other hand, if there is a surprise on Wednesday, some people will suffer from a little bit of a reversal in this trade. But I don't know if we have some customers trading this market. If you do, reach out. I trade a lot of SOFRs. I like it actually. And that's the positioning from the rate market, how we are going into this, right? Simplistic view, I know, but we have just a few minutes, and there's actually a lot to picking up in this market. So I always give you a little bit of an overview just. All right. The main topic of this little presentation today is the energy market. Oil is basically the second most stuff I trading all the time. And it's very, very interesting because the last weeks we have produced some research, sent it out to the community, that oil is actually pretty bullish. Myself, I had longs in CL sub 60. It was like 59.80, something like that, right? And I hold this trade to the whole of May, basically. It was quite kind of a pain trade because the WTI was mainly in mean reversion, where you don't have that much trends over the day, but we escalated pretty quickly, right? And the peak of escalation was Thursday and Friday last week. Actually began already a little bit on Tuesday. And the cool thing in energy market is they can be really boring and really dumb for days, weeks. But if you have a move like we have seen last week, you can actually bank in pretty quickly, right? But also it's pretty tough to trade actually in these events, right? So it's a 4-hour chart here, and if you are looking at the big green candles and how they are looking, that's quite a move in CL, right? From $70 to $74. That's actually big. Why is it like that? Because some news had hit the tape, and algorithmics are going on. Volatility is expanding always, and the white chart on the left side is simple spoken, the volatility for the continuous CL contract. That's CME data. It's public available. You can search for it. It's called the CME Quick Strike tool, right? You just have to make an account over there. But it's a little bit hard to read. You have to dig in a little bit what stuff actually means. So it's not that tourist friendly, I call it like that. And if you can see, the volatility is pretty high. The June volatility peaked out over 70 already, which is already higher than October 2024, where we had also an escalation in the Israel-Iran conflict. And what does this mean already? It's expensive to set on trades, right? And if stuff is expensive, you may get burned a little bit more. So, but as you can see in the chart, the white lines, basically the two news has hit the market goes parabolic, and now we are trading around over there. All right. So now let's say you wanna go long, all right? Of course, you can do it always with basic technical analysis. I'm never the guy that says this is wrong or this is correct. If you are a pretty good crack in this part of the market with technical analysis, go your way. But I prefer to always get a little bit more knowledge into these markets. Those slides are looking a little bit weird, but I think it's kind of interesting, and maybe this context helps you a little bit. I also decided to build this because the takes on X, formerly Twitter, and other social media channels over the weekend, they were hilarious, actually. People were talking about $120 for oil. Then there was also a pretty bad take about natural gas because gas field XYZ was hit. But what the hell does this mean for NG futures in America, how they are connected? No one can tell you, and that's the big problem, right? You can trade this stuff always, but if you pump out knowledge or label this stuff as knowledge, people usually don't have that of a strong view. So let's change this a little bit, okay? Well, we are not doing a deep dive here, just a little bit scratching on the surface. All right. Why the escalation in oil? Of course, positioning plays a vital role in this. Positioning comes after this slide, so we have to connect it a little bit. But the main take behind the actually volatility in oil that has been expanding last week was the outcome of the future. Does the situation get worse? What's the worst thing that could happen over there? This is the map on the right side, upper right side. This is the so-called Strait of Hormuz. It's strait in the ocean. There's the Oman down there, and the other landmass on the left-hand side over there, the orange thingy, this is Iran. And the main takeaway was that Iran is do a blockade on the strait, so it's actually closed for shipping. That would have mean 20% of the global oil supply would be cut off, and that would actually be a big problem, right? And I always said to the people in our community, and also during the weekend over Twitter, it won't happen. Or let's say the possibility it won't happen is pretty low, because you have to know the Iran is exporting 90% of oil to China. The other 10% is like Venezuela and some other South American countries. And for war, you need money, and you get money with commodities pretty good, right? It's still the main thing. Russia exists like decades because they have as full of commodities and they sell it for good money. So why the heck should the Iran block the strait, right? Because they can't sell their oil afterwards. They did it. On top of that topic, the Oman also plays a pretty vital role down there because they own a little bit of traffic lines over there. And the Iran would basically piss off the Oman as well. The next thing was, and this was priced in by oil a little bit, is the next map below, which are oil and gas fields of the Iran. And usually, if those infrastructure stuff gets attacked and destroyed, also the oil demand and supply gets a little bit out of balance in the world. And yes, it's true, those markets are connected into the world, right? If the Iran cannot ship 2 million barrels per day, that's fantasy numbers, of course, right? To China, and they maybe can just ship 1 million. China still needs the other million of barrels per day that's missing, right? And they will buy it otherwhere, and price of oil is going up. But prices of oil, they won't go up $100 to $120 just because some oil fields are getting bombed and also some natural gas fields are getting bombed, right? That's actually a little bit of commodity knowledge. Usually commodity traders are well aware of this stuff, but the tourists out there on social media, it was a little bit too much for me, so I decided to put this a little bit up here. All right, this is fundamentally stuff, right? It's even more geographics and how this market works actually. On the other hand, you have some intermarket indications, let's put it like that. The candlestick chart on the left side is the so-called crack spread, right? This is an industry standard where you can basically put out how profitable oil companies are working, right? It's a formula built out of what products can be refined from 1 barrel of oil. And as you can see, the stuff is going down. It does not mean that oil has to go down all the time, but it shows that profitability is kind of weak and kind of vanishing a little bit. This is more for the broad overview of the market overall, but I still put it in there because it's fundamentally stuff. And the line chart, the orange one below, is the so-called prompt spread. Prompt spread in commodity futures always compares the actually front month that is trading with the next one. You build a spread out of this, and how these spreads are widening or tightening in combination how the future term structure is, backwardation, like we have in oil the last year maybe, right? Over a year already, backwardation, or contango. You can gain a little bit more of a view, and prompt spreads have actually played a vital role in my trade, which I told you a few minutes ago. up from the 60s because these spreads were blowing out all the time. Again, does not have to mean that the contract you are trading is ticking up immediately. It's just something you have to watch, but not on a 5-minute time frame. Maybe daily time frame, a little bit lower, like 4 hours, because as you all know, future term structures, they move in lockstep, pretty basically said. And yeah, if those spreads are tightening or getting a little bit wider, it's also reflected in the price that you're actually trading. Also, we have different market participants in oil. This is from our CTA model. On the left side, yeah, there is crude oil, the WTI, and on the right side is the Brent, which is the European North Sea blend for oil. And yeah, what was a little bit obviously into April, May, there was selling from CTAs, right? There are trend followers. And what I always try to tell the people in our community, especially in stuff like oil, what else? Gold can be working as well. Soft commodities also pretty famous for this phenomenon. Usually they are working pretty good as a contraindication, right? Because now you have those trend followers here, which are represented by the green lines. You can see they are trading fairly down, right? And oil is already ticking up. So, and the CTA is not like you and me, where they have like 75 ticks stop in CL. They actually run big books, and they are actually in the oil market a very big market participant. And usually I use this stuff for like if fundamentally or intermarket wise is something changing, aka Thursday or Friday last week, and those people are barely long or slightly short, well, they should cover, right? Or they should chase the upside a little bit. And if you put this together with the volatility chart I have shown you for the CL, well, it's even more expensive for them, right? Because it also means if they are chasing those squeezes in CL, they have to put on way more risk, right? Because the price can, under a high volatility environment, reversal also a little bit quicker. So when those guys are short, and the oil price is ticking up for whatever reason, like we have seen last week, they usually have to chase and jump up and enforcing the long trend, right? Yeah, and this is stuff that we have seen on Thursday, also Friday. Of course, there's also a little bit of risk hedging for this market, right? Because no one knows what will happen over the weekend, right? Especially geopolitical risk. It's always a bet. I mean, of course, the situation can escalate way worse, way quicker than everybody thought. And then you want to be long oil, right? Because when you're going Monday to your desk and you don't have an oil position opening, but oil is open like 10-12% higher overnight because the next war has broken out, probably your MD will come to you and say, hey, what the hell, why you don't make money out of this, right? Okay, positioning, we have talking about volatility a little bit, CTAs, positioning from the option side always adds a little bit more color to the context. This now is especially useful if you trading intraday, also of course a little bit for the longer time frames. Usually when you have more volatility in oil markets or other commodities, people are a little bit surprised that this stuff actually can move $2.50, $3, $4, whatever, you know what I mean. So it's pretty important to look at positioning like we have here, the next two future contracts for the CLM 05. And as you can see, yeah, we are crowded around 70, 72, 73. And it's a little bit obvious on the right side, we topped out 75. Over there is nothing that really more. And I think we opened overnight a little bit over 75, but we have reversed it down pretty hardly. And basically, what does this mean? If those options are in the money, if they are deep in the money, they are not moving that much, right? Because if you have, let's say, a long call 70 for CL future, but CL is trading at 75. Yes, you banked in, you make really good money, but as price goes higher, your payout profile does not changing that much, right? Because it's so deeply in the money, all the stuff. And as you can see, those deeply in the money positions, if we are eyeballing this a little bit, I would say it's 68 up to 71. This is the majority of the positions that should be showing up with a BV profit, right? So my take would be, if you want to be long in oil, if you want to speculate on more upside, 70, of course, right? That's a strike we have to watch. But on the other hand, this has to combine with the stuff I told you a little bit before, right? Of course, you can set up a nice options trade out of this a little bit. But yeah, my style is more like I did on Sunday, wait for the open and short it, right? Because there was no further escalation over the weekend. And with this volatility expanding and also implied volatility has blown up in oil, it was for me more profitable to short this. I think it's still open. I'm not at my laptop where I'm trading from, so have to see later a little bit. Yeah, but basically you can see it's not that easy that you can pump out a take where you say, oh, $120 in CL Monday, let's pencil it in, bam. Doesn't work like that, guys, okay? It's a really competitive field, commodity trading, especially in oil. It's the most used commodity in the world. We need it for everything, we need it for everyone. So you have to dig in a little bit deeper to actually make a living from it, all right? So this is already the last thing as we are going into next week. I'm pretty sure you guys are aware that we are still having a little bit of risk on. That's the reason why I built in this little chart down there below with in green the ARC ETF, which I always use to measure if we are buying big garbage numbers into the market, because ARC is basically unprofitable tech and all this stuff. Contrary to this stuff, people talking a lot about higher rates. That's the reason why I put in the US 10-year yield and the US 20 yield above there a little bit. And those red boxes labeled with Trump headline risk. Usually this was a time in the market where we had a trade deal announcement or stuff like, oh, you should buy stocks, right? So great. What want to say with this? Yields and stocks may rise in tandem a little bit, right? From my side, it's not that great to be long bonds yet again. Even with last week's risk on geopolitical risk, they haven't seen a bit, right? It was so sluggish, this market. It looks a little bit to me to the short side. Eventually, we will see on Monday how the market reacts to the FOMC if we are getting anything new. But main takeaway here, risk assets like stocks, even IWM, sorry, are unprofitable tech. For me, it looks like this was a welcome dip on Friday, and we bought it again, right? And this stuff over here with the tickers we have spoke about, map this against the volatility stuff from few paints earlier, and I'm pretty sure you will find something to trade about out of it, right? So that's it. A lot of oil. I promised next Macro Monday do a little bit more cross asset stuff, but was kind of important for me to talk about this over the weekend, and I hope someone takes a little bit out of it.
Thank you, Tim. And this was awesome as always. And thank you, guys. So I think we're gonna have some more session this week, but it's for now we're gonna conclude this Macro Monday. And thank you, Tim, again for your content.
Yeah, and tomorrow is Jay, right, with FX stuff.
Yeah, tomorrow we're gonna have a live training session on forex.
Yeah.
9:30. So stay tuned, guys. It's going to be available on our YouTube and our calendar. So yeah, that would be really, really good.
Yeah, you should definitely attend this, guys. I know him a little bit, Jay. He's also German. He was former Lehman Bros employee, also SocGen, Nomura. Really, really big titan. Maybe not in the English-speaking part of the market, but in Europe is pretty known, right?
Yeah.
So always interesting.
Yeah, it would be great.
All right.
Thank you, guys.
Keep it like that and have a good one.